Imagine waking up one morning, checking your portfolio, and seeing that the stock market has plunged another 10%. News anchors are using words like panic, crisis, and recession. Investors are rushing for the exits. Retirement accounts are bleeding red. Social media is flooded with fear. For most people, a market crash feels like a financial nightmare. But what if I told you that some investors actually make money when markets collapse? What if the very event that destroys billions of dollars in wealth every year could become one of the biggest profit opportunities in your investing journey? Today, we're diving into a powerful strategy used by experienced traders and sophisticated investors to potentially profit during recessions, bear markets, and major stock market crashes. We're talking about inverse ETFs and put options, two financial tools specifically designed to benefit when stock prices move lower. By the end of this video, you'll understand how these instruments work, why they can be valuable during economic downturns, and most importantly, how to use them responsibly without turning your portfolio into a casino. To understand why inverse ETFs and put options exist, we first need to understand market cycles. The stock market doesn't move in a straight line. It experiences periods of growth, optimism, and expansion, followed by periods of fear, contraction, and decline. Recessions have occurred throughout modern financial history. We've seen the dot-com crash, the global financial crisis of 2008, the pandemic crash of 2020, and numerous corrections in between. Every time, millions of investors watched their portfolios shrink, yet during those same periods, a smaller group of investors positioned themselves to benefit from falling prices. The key difference wasn't luck, it was understanding the tools available to them. Let's start with inverse ETFs, because they're generally easier to understand. An ETF, or exchange-traded fund, is simply a basket of securities that trades like a stock. Most ETFs are designed to rise when the market rises. For example, if the S&P 500 gains 10%, an S&P 500 ETF typically gains about the same amount. An inverse ETF works in the opposite direction. Its goal is to rise when the underlying market falls. If the S&P 500 drops by 1% in a day, an inverse ETF tracking that index may gain approximately 1%. Think of it as a mirror image of the market's movement. Imagine you strongly believe that the economy is heading into a recession. Consumer spending is slowing, corporate earnings are weakening, the Federal Reserve is maintaining high interest rates, unemployment is starting to rise. Instead of selling your entire portfolio and sitting in cash, you could purchase an inverse ETF. If the market declines, the inverse ETF may generate gains that help offset losses elsewhere in your portfolio. This is one reason institutional investors often use inverse products as hedging tools, rather than purely speculative investments. Now, it's important to understand that not all inverse ETFs are created equal. Some aim to provide a one-to-one inverse relationship with an index. Others use leverage. A leveraged inverse ETF might attempt to produce 2 or even 3 times the opposite daily return of an index. That means if the market falls 2% in a day, a triple inverse ETF could theoretically gain 6%. While that sounds exciting, leverage is a double-edged sword. If the market moves against you, losses can accumulate much faster than many investors expect. One of the biggest misconceptions about inverse ETFs is that they are designed for long-term investing. In reality, many of these products reset daily. This means their performance over weeks or months may differ significantly from what investors anticipate. Market volatility can create a compounding effect that causes returns to diverge from simple expectations. This is why experienced investors often treat inverse ETFs as short-term tactical tools rather than permanent portfolio holdings. Now let's move to put options, which are considerably more powerful and also more complex. A put option is a financial contract that gives the buyer the right, but not the obligation, to sell a stock or index at a specific price before a certain expiration date. At first, this concept sounds confusing, but let's simplify it. Imagine you own a house worth $500,000. You're worried that housing prices may crash over the next year. You purchase an insurance policy that guarantees you can sell your house at $500,000 even if market prices fall to $400,000. Your insurance becomes extremely valuable. Put options function similarly. They can increase in value when the underlying asset declines. Suppose a stock is trading at $100 per share. You believe economic conditions are deteriorating and expect the stock to fall. Instead of short selling the stock, you purchase a put option with a strike price of $100. If the stock falls to $80, the value of your put option could increase substantially. The larger the decline, the more valuable the option may become. This ability to potentially generate significant gains from falling prices is what makes put options attractive during market downturns. One reason professional professional investors like put options is leverage. With a relatively small investment, they can gain exposure to a much larger position. This means even a modest market decline can produce substantial percentage gains in the option's value. However, leverage cuts both ways. If the market doesn't move as expected, the option can lose value rapidly. Unlike stocks, options have expiration dates. Time is literally working against the buyer. Every day that passes reduces the remaining life of the contract, a concept known as time decay. This is where many beginner investors make mistakes. They correctly predict that the market will eventually decline, but they choose the wrong expiration date or pay too much for the option. The market may fall after their option expires, leaving them with a complete loss. Timing matters enormously when trading options. Being right about direction is not always enough. You also have to be right about timing. Another important concept is implied volatility. During periods of fear, option prices often become more expensive because demand increases. Investors rush to buy protection. This can create situations where put options are priced at a premium. Even if the market declines, the gains may not be as large as expected because the high volatility was already built into the option price. Understanding this dynamic separates experienced options traders from beginners chasing headlines. Now let's talk about how inverse ETFs and put options can fit into a broader recession strategy. One approach is hedging. Rather than trying to predict every market movement, investors use these tools to reduce overall portfolio risk. Imagine you have a $200,000 retirement portfolio heavily invested in stocks. You don't want to sell your long-term investments because doing so may trigger taxes, disrupt your strategy, or miss future recoveries. Instead, you allocate a small percentage of your portfolio to inverse ETFs or protective put options. If the market declines, those positions may help cushion the impact. This strategy can be particularly useful for investors nearing retirement. Someone in their 20s may have decades to recover from a bear market. Someone planning to retire within 5 years may not have the same luxury. Risk management becomes increasingly important as investors approach major financial milestones. In these situations, downside protection can be just as valuable as chasing higher returns. It's also worth discussing the psychological advantage of having a recession plan. Market crashes are emotionally challenging. Fear causes people to make poor decisions. Investors panic sell near the bottom, they abandon carefully constructed portfolios, they stop contributing to their 401k plans, they miss the eventual recovery. Having a strategy in place before a crisis occurs can help investors remain disciplined. Knowing that part of your portfolio may actually benefit from falling markets can reduce anxiety and improve decision-making during turbulent periods. History provides several fascinating examples. During the 2008 financial crisis, major stock indexes lost enormous value as the housing market collapsed and financial institutions faced unprecedented pressure. Investors with bearish positions, protective puts, or inverse exposure were among the few participants generating gains. Similar opportunities appeared during the pandemic crash in early 2020, when markets experienced one of the fastest declines in modern history. While no one can predict the exact timing of future recessions, history repeatedly shows that downturns are an inevitable part of investing. However, there's a critical warning every investor must understand. Profiting from market crashes is not easy. If it were, everyone would do it. Markets often remain irrational longer than expected. Economic indicators may suggest a recession is coming, yet stocks continue climbing for months. Investors who position themselves too early can suffer significant losses while waiting for the downturn to arrive. This is why risk management is absolutely essential. Successful investors focus less on predicting the future and more on preparing for multiple outcomes. They recognize that markets can rise, fall, or move sideways. They build diversified portfolios. They maintain emergency savings. They manage debt responsibly. They understand tax implications. They continue contributing to retirement accounts. And when appropriate, they use tools like inverse ETFs and put options as part of a broader strategy, rather than treating them as get-rich-quick schemes. The biggest lesson is that market crashes don't have to be viewed solely as disasters. They can also create opportunities for disciplined investors who understand how financial instruments work. Inverse ETFs provide a relatively straightforward way to gain exposure to declining markets, while put options offer more flexibility and leverage for those willing to learn their complexities. Neither tool is magic, neither guarantees profits, but both demonstrate an important truth about investing. Opportunities exist in every market environment, not just during bull markets. So the next time financial news is filled with recession fears and predictions of economic doom, remember this: